Amazon stock, ticker symbol AMZN, is falling here after the bell, after it reported its earnings. And we're going to talk about why. We're going to talk about why Amazon is down 4% and is the market justified in selling Amazon into these earnings. We're going to talk about everything because Amazon gives us a great preview into how the consumer is holding up, but also how the AI trade is doing. So we're going to talk about it. We're going to talk about Amazon. Let's dive in. But before we do that, please go ahead and subscribe. It really, really helps a channel like mine out. Now, Amazon, a beat on the top line, a beat on the bottom line. The company grew 8.6% in revenue. They reported $155 billion in revenue, about 700 million more than what the analysts were expecting. And then they reported $1.59 versus $1.36 in EPS, which grew 62.2%. And again, that goes to the operating leverage being built by the new CEO, Andy Jassy. Now, the reason why the stock is actually falling isn't because of these earnings. It has to do with guidance. Now, operating profit, the company guided for $15.3 billion. The market was expecting a smidge under $18 billion. However, net sales, they guided in line. So all in all, what we did see is a double beat and a lower of guidance expectations. Margins continue to improve across the board. This was the highlight of the report. Gross margins increased from 49.3 to just over 50%. Operating margins increased 120 basis points. We saw operating income go from 15.3 to $18.4 billion. However, what was really concerning was free cash flow margin, and this has to do with capital expenditures. The free cash flow margin was actually negative for the quarter, negative 5.4%. The company lost $8.1 billion of free cash flow for this quarter. The previous margins were 2.84, and the company saw $4 billion in free cash flow. The company has a ton of debt on the balance sheet, and this is why this isn't such a good thing, especially as it pertains to their debt. However, they are sitting on $94 billion worth of cash. Absolutely insane. So while the debt is huge, it's not an issue at all, especially when the company's doing $700 billion in revenue for the year. Let's talk about Amazon's individual segments and look at their growth overall. Online stores actually grew 5%. That's very interesting. That is their legacy business along with the third-party seller service. Now, third-party sellers actually decelerated from the same quarter last year, which saw 16% growth. That decelerated to 5% growth, and that probably has to do with fees associated with that. Amazon can probably go ahead and re-accelerate that growth if they fix up their fee structure. I know it's not the best right now, but both these segments together producing about $88 billion per quarter for Amazon. Absolutely insane. Amazon Web Services grew 16.8%, again, decelerating from the same quarter last year, but still mid-teens growth, a $30 billion per quarter revenue run rate for Amazon Web Services. That's a huge business line, and this business line produced 66% of the company's operating cash flow. So it's a very, very important segment. Advertising also grew about 17%. It previously grew at 24%, but we are seeing revenues decelerate throughout Amazon's business line right here. But it just gets to a point where you're producing like $155 billion in revenue every single quarter. How do you keep that up? And we are starting to see revenue decelerate. Nonetheless, AWS and advertising are still their fastest growing segments and do expect growth and operating income to come from these two segments. Subscription, which is Amazon Prime, grew 10%, now makes up $11.72 billion. It's a nice sprinkle on top of what they're already doing. Physical stores and other, which is, just the physical stores and then their other strategic bets, grew about 3 to 6%. It makes up about $7 billion of total revenue. It's inconsequential, really, but it can turn out to be something much bigger. About 7 years or so, the Amazon AWS was actually in the other segment losing money. AWS now does $30 billion per quarter, a $120 billion revenue run rate for the year. Absolutely insane. Now, when you look at the income statement in aggregate, revenues grew 8.6%. We know this. Operating expenses actually grew only 7.2%, and that has to do with that operating leverage. Andy Jassy trying to make the company more efficient. That's great. And that is why we actually saw basic earnings per share grow 62% from $1 to $1.62. So this is actually really, really good. However, that did not translate directly into free cash flow. Free cash flow was actually negative about $8 billion. So the company had to use its cash and its debt to service the business's capital expenditure, and you could see a purchase of property, plant, and equipment increased 74% on a year-over-year basis. Now, that is a huge jump. They're expecting about 115 billion this year, so that growth rate should decelerate, but the nominal figure is still significantly higher. So Amazon plowing money into its other bets, AI, AWS, its warehouses, and all of that means capital expenditure is exploding in what was an already CapEx heavy business. Now, this is something to watch because capital expenditures is actually growing faster than earnings and faster than revenue. And if this continues, that can be detrimental for the business's solvency down the line and its ability to take on more debt. Looking at some highlights in the first quarter, Alexa Plus launched their next-gen AI assistant. It's completely free with Prime. Project Kuiper launched its first satellites aiming to provide rural broadband access that is a competitor to Starlink. Amazon Nova, which is just expanded capabilities of AI. They've released a whole bunch of new features, and AWS signed new deals with Adobe, Uber, Nasdaq, Fujitsu, Mitsubishi Electric, and many more partners. They also finally launched here in Ireland, Amazon.ie, and they have the ongoing deployment of their autonomous vehicle fleet, which is called Zoox in Los Angeles. Again, a competitor to Waymo. So Amazon is competing in all of these spaces. They have so many business lines, produce so much revenue, and that is why they're deploying so much capital expenditure. So if you are going to be an investor in Amazon, what should you watch right now? I think the biggest thing is you want to look at AWS's momentum and profitability because AWS generated 63% of Amazon's total operating income. This segment has nearly 40% margin. So you want to see what growth looks like in the future. If the AI megatrend continues, expect AWS growth to remain robust. The second thing you want to look at is CapEx trajectory and free cash flow. Will it make a rebound? Will CapEx accelerate? What's it going to look like? Because again, in the longer term, that type of growth against what the company's growing in revenue is a little bit of a concern. I think you want to look at consumer spending and retail margins, okay? That's something else. The retail business is still an $80 billion business per quarter that does produce a lot of revenue for Amazon. And if that business starts to see negative growth, that can impact the business as a whole, especially because it is hemorrhaging cash right now. And then the next thing you want to look at is the execution of its strategic bets. It's AI, it's Kuiper project, it's autonomous vehicle fleet. You want to see these paying off. You want to see these producing a revenue to the top line. All in all, though, I think Amazon's moat continues to remain wide and unchanged. And I think the thesis for Amazon is intact. Now, with the valuation, it's very, very hard to value Amazon on pretty much any metric besides operating cash flow. But on an EBITDA basis, it trades at 15.4 times. So it's not super expensive, but not cheap either. Its shareholder yield is 0.6%. And I think this is mostly just paying down debt. They don't pay a dividend or buy back any shares. Now, looking at our valuation framework here for Amazon. So what we are projecting is 10% revenue growth for Amazon with 13% margins. Now, I know it says net margins, but this is actually operating margin, operating income, and then the price to operating cash flow. That is the multiple we're using right now. And so we're using an 11.8% margin, and that's going to expand to 13 by 2029 with 10% revenue growth. And look what's interesting, by 2029, you could actually see Amazon do $1 trillion in revenue. Just insane. They currently do 650 billion in the trailing 12 months. So you get operating income of 136 billion for the full year. We're going to use a ratio of 15 times. So then you get the enterprise value, subtract the net debt, you get the equity value, divide by shares outstanding. We're assuming shares outstanding stay the exact same. And then in 2029, you get the stock price here of $188. The current stock price is $190, which is a compounded annual growth rate of negative 0.15%. So is Amazon a buy right now? Absolutely not. I don't think so. I don't think the valuation makes sense for this business. Maybe I'm missing something. Leave it in the comments below, but to me, the business is just not attractive at the moment. On a technical basis, it does look like the market thinks it is attractive, forming a higher low relative to this low right at these levels right here at the 160 level. You could see that the 200 mark, which was a very, very strong resistance zone, a couple times here as well. And then we pivoted off to go ahead and make new all-time highs for Amazon at the 240 region. So the 200 zone is a very strategic zone. This is where the 200 moving average currently is. So if we do go to this level, and break above, then we could probably go ahead and target those all-time highs. But me personally, I'm not a buyer of Amazon. But if you made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.